Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Arthur J. Gallagher Co., a global insurance brokerage, risk management, and consulting services firm. Gallagher has been a significant player in the insurance industry for decades, offering a wide range of services to businesses and individuals. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Gallagher's business model revolves around managing risk and providing insurance solutions. From a behavioral finance perspective, how do biases like the status quo bias and risk aversion influence their decision-making, especially in areas like client management and policy structuring?
The status quo bias is particularly relevant to Gallagher's approach, especially in how they manage their relationships with clients and structure insurance policies. The status quo bias refers to the preference for maintaining existing conditions rather than making changes. Gallagher leverages this bias by focusing on providing stable, consistent insurance solutions that clients can rely on year after year. This approach helps build long-term relationships with clients who prefer the security of sticking with a trusted broker. Risk aversion, another key behavioral finance concept, plays a significant role in how Gallagher approaches both its own business strategies and the services it offers to clients. Risk aversion refers to the tendency to prefer avoiding losses rather than acquiring equivalent gains. Gallagher's focus on risk management aligns with this bias, as they provide services designed to minimize potential losses for their clients. This emphasis on risk mitigation is particularly appealing in the insurance industry, where clients often prioritize stability and security over high risk, higher reward opportunities.
And this focus on leveraging the status quo bias and risk aversion has helped Gallagher maintain its leadership position in the insurance brokerage industry, appealing to both clients and investors who value reliability and prudent risk management.
Exactly. Gallagher's strategic use of the status quo bias in maintaining client relationships and risk aversion in structuring policies appeals to investors looking for a company that balances operational stability with strategic growth. However, this approach also means that Gallagher must carefully manage the risks associated with market volatility, regulatory changes, and competitive pressures, particularly as the insurance industry continues to evolve with new challenges and opportunities.
Let's talk about diversity, equity, and inclusion at Gallagher. As a major player in the insurance industry, DEI is particularly important for Gallagher. How does this intersect with behavioral finance?
Gallagher's approach to DEI is crucial, especially as the company operates in a global and highly regulated industry where inclusivity can drive better decision-making, innovation, and employee engagement. From a behavioral finance perspective, strong DEI initiatives can enhance Gallagher's ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows Gallagher to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in the insurance industry. For investors, Gallagher's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Gallagher build stronger relationships with employees, clients, and communities, reinforcing its brand as one that values inclusivity and ethical leadership.
Investors are increasingly considering DEI when evaluating companies, especially in industries like insurance, where the ability to foster inclusivity and innovation is critical to long-term success.
That's right. By embedding DEI into their corporate culture and operational strategies, Gallagher not only improves its ability to serve a broad range of stakeholders but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to market adaptation, Gallagher operates in a highly competitive and regulated industry. How does the company adapt to changing market conditions and regulatory environments, and what role does behavioral finance play in this?
Gallagher's strategy involves continuously adapting its service offerings, regulatory compliance, and client engagement efforts to meet the evolving needs of the insurance market while maintaining its focus on risk management and client satisfaction. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with market volatility, regulatory changes, and competitive challenges. Gallagher's ability to understand and respond to new market trends such as the increasing demand for cyber insurance, the shift towards digital insurance platforms, and the growing importance of sustainability and risk management allows it to stay relevant and competitive. By using data analytics, client feedback, and market research, Gallagher can identify emerging opportunities and adjust its strategies accordingly, helping to mitigate risks and capitalize on new opportunities in the insurance industry. And this adaptability is essential for Gallagher, especially as they face competition from other insurance brokers and the growing demand for more specialized and innovative insurance solutions. Their ability to maintain their brand's relevance and leadership in a changing industry is key to their continued success. Exactly. Gallagher's focus on understanding market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the insurance brokerage industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in regulatory landscapes, technological advancements, and competitive pressures.
Now, let's compare Gallagher to other companies in the insurance brokerage and risk management sectors like Marsh McLennan, Aon, and Willis Towers Watson. How do the behavioral finance dynamics differ?
Gallagher's dynamics are often compared to other insurance giants like Marsh McLennan, Aon, and Willis Towers Watson, particularly in their approach to risk management, client engagement, and competition. Gallagher's strength lies in its focus on personalized client service and risk management solutions, appealing to investors looking for a company that balances operational stability with market leadership. Marsh McLennan, with its emphasis on global reach and diversified services, appeals to investors interested in a company that prioritizes scale and market dominance. Aon, known for its leadership in risk management and human capital solutions, attracts those looking for a company that is driving advancements in integrated risk and talent strategies. Willis Towers Watson, with its focus on advisory, broking, and solutions across risk and capital, appeals to investors interested in companies that integrate strategic advisory with operational execution. Gallagher's behavioral finance dynamics are shaped by its reputation for client focus, strong market presence, and adaptability, making it an attractive option for those seeking stability and growth in the insurance industry.
And unlike Aon, which focuses heavily on risk management and human capital solutions, Gallagher's strength lies in its specialization in personalized insurance and risk management services, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Gallagher, the focus on client service, risk management, and market adaptability provides a unique value proposition in the insurance brokerage industry.
To sum up, Arthur J. Gallagher Co. S approach to business is deeply influenced by behavioral finance principles, whether it's through their client management strategies, adaptation to changing market conditions, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Gallagher's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.